Today, I'm revealing 8 overlooked investment strategies quietly paying out jaw-dropping yields. Let's dive in and discover more. High-yield dividend stocks are some of the market's most underrated income generators. While many investors are drawn to the excitement of fast-growing tech companies or the latest market trends, there's a quieter corner of the market that consistently rewards patient shareholders. These high-yield dividend stocks may not make headlines, but they have a long history of delivering steady, reliable income year after year. While everyone chases tech stocks, established companies in sectors like telecom and energy quietly pay out 8 to 9% yields. These sectors are often the backbone of the economy, providing essential services that people rely on every day. Because of their stable business models and predictable cash flows, these companies can afford to return a significant portion of their profits to shareholders in the form of dividends. These aren't risky penny stocks. They're mature businesses with steady cash flows, returning more capital to shareholders. Many of these companies have weathered multiple economic cycles, proving their resilience and commitment to rewarding investors. Their ability to generate consistent profits allows them to maintain and sometimes even grow their dividend payments over time. Because they're not flashy, they're often ignored, creating opportunities for savvy investors seeking reliable income. In fact, the lack of hype around these stocks can work to your advantage, as it often means they're undervalued compared to more popular investments. For those willing to look beyond the headlines, these overlooked giants can be a powerful tool for building long-term wealth. Reinvesting dividends from these stocks can supercharge your compounding returns. By automatically using your dividend payouts to purchase more shares, you can accelerate your portfolio's growth, turning a steady stream of income into a snowball effect that builds wealth over time. This strategy is especially effective with high-yield stocks, where the reinvested dividends can quickly add up. Just remember, do your homework. Focus on payout ratios and business stability. Not all high-yield stocks are created equal, and it's important to ensure that the company's dividend is sustainable. Look for businesses with strong balance sheets, healthy cash flows, and a track record of maintaining or increasing their dividends, even during tough times. Don't overlook these giants if you want consistent, repeatable income. By adding high-yield dividend stocks to your portfolio, you can create a reliable foundation for financial security, allowing you to benefit from both steady cash flow and the potential for long-term growth. Real estate investment trusts, or REITs, are often described as silent yield machines, generating steady streams of income for investors, quietly and efficiently, behind the scenes of the bustling real estate world. While many people walk past towering office buildings, sprawling apartment complexes, or even specialized facilities like data centers every day, few realize that these properties can be owned collectively through REITs, making it possible for everyday investors to tap into the lucrative world of real estate without ever buying a building themselves. Despite the occasional negative headlines about the real estate market, many REITs, especially those focused on essential sectors like data centers, logistics, healthcare, or residential rentals, continue to deliver stable, attractive yields. These companies own and operate properties that are in constant demand, providing the backbone for everything from cloud computing to affordable housing. Their ability to generate consistent rental income, even during economic uncertainty, makes them a resilient choice for investors seeking reliable returns. By law, REITs must pay out at least 90% of their taxable income as dividends to shareholders. This unique structure means that investors regularly receive a share of the profits, often in the form of quarterly or even monthly payments. For those who prioritize income, REITs can be a powerful tool for building a steady cash flow, whether you're saving for retirement or simply looking to supplement your earnings. One of the biggest advantages of investing in REITs is the ability to gain exposure to real estate markets without the headaches of being a landlord. There's no need to worry about fixing leaky faucets, chasing down late rent payments, or managing tenants. Instead, you can enjoy the benefits of property ownership, like appreciation and income, while leaving the day-to-day management to professionals. To maximize your returns and minimize risk, focus on REITs with strong balance sheets, a history of consistent dividend payments, and diversified property holdings. These companies are better positioned to weather market fluctuations and continue rewarding their investors over the long term. With a bit of research and due diligence, you can uncover some of the market's most reliable high-yield opportunities. REITs offer a unique blend of growth, income, and diversification, making them a smart addition to almost any investment portfolio. Preferred shares truly offer the best of both worlds, combining features of both stocks and bonds into a single investment. They're a unique financial instrument that gives investors the opportunity to enjoy the steady income of bonds, while still participating in the equity market like a stockholder. This hybrid nature makes them especially attractive for those seeking a balance between risk and reward. With yields often north of 7%, preferred shares can provide a higher income stream than many traditional bonds or savings accounts, and they tend to experience less price volatility than common stocks. One of their standout features is the fixed dividend, which is paid out regularly and takes priority over dividends paid to common shareholders. This means that even in tough times, preferred shareholders are more likely to receive their payments. For retirees or anyone looking for a stable income source, preferred shares can be a reliable choice. They're typically issued by well-established, financially sound companies, adding another layer of security for investors. Despite these advantages, preferred shares often fly under the radar. They don't get much attention in the media, so many investors simply overlook them when building their portfolios. Some preferreds are callable, meaning the issuing company can buy them back at a set price after a certain date. It's important to understand this feature, as it can affect your long-term returns and investment planning. Another key consideration is interest rate sensitivity. When rates rise, the price of preferred shares can fall, so it's wise to keep an eye on market trends and adjust your strategy accordingly. But if your main goal is to generate consistent income, preferred shares can be a powerful tool in your investment arsenal, helping you plan for the future with greater confidence. Adding preferreds to your portfolio can diversify your income sources and provide a cushion against market swings, making them a smart addition for many investors. Don't miss out on this hybrid asset class. Preferred shares can deliver high, steady yields and help you achieve your financial goals with confidence. Closed-end funds, or CEFs, trade at discounts and can offer yields up to 9%. Their fixed share count means you can buy assets below their true value, especially when markets are fearful. Many CEFs use leverage to boost returns, so check for experienced managers and sustainable payouts. Always review the fund's distribution policy. Some payouts may include return of capital. With careful selection, CEFs let you access high-yield assets at a bargain. For income investors, that's a rare and powerful combination. Business development companies, or BDCs, lend to small businesses and pass on high yields, often 8–10%, to investors. They're required to distribute most of their earnings, making them a goldmine for yield hunters. BDCs can be volatile, so look for diversified portfolios and strong management. Loan covenants help reduce risk, even in tough markets. Focus on quality BDCs with a history of consistent dividends. If you can handle some volatility, BDCs are a hidden gem for high income. Master Limited Partnerships, or MLPs, own energy infrastructure and pay out most of their earnings as distributions, often 8–10% yields. Their revenues are built on long-term contracts, making cash flow stable even when energy prices swing. MLPs are often ignored due to tax complexity, but the paperwork is worth the income. Part of the payout is usually return of capital, deferring taxes and boosting after-tax yield. Diversify across several MLPs to manage risk. For stable, high yields, MLPs are tough to beat. International high-yield bonds offer 8 to 9% yields and diversify your portfolio beyond U.S. markets. Yes, there's currency and political risk, but global bonds can boost returns and reduce overall volatility. Use funds or ETFs to hedge currency risk if needed. Diversification is key. Don't concentrate in one country or sector. Look for experienced managers with a track record in global markets. International bonds often move independently from U.S. assets, adding resilience. Do your due diligence, but don't ignore the world of global high yield. Covered call ETFs generate extra income by selling options on stocks they own, often yielding 8 to 10%. These funds are managed by pros, so you get equity exposure plus steady option premium income. The trade-off: you cap some upside if markets rally, but in sideways markets, yields soar. Many covered call ETFs track broad indices, adding diversification. Reinvest dividends to compound returns even faster. If you want to supercharge your yield, covered call ETFs are a must-consider strategy. There you have it. 8 overlooked ways to unlock hidden yields and generate real, consistent income. Diversify across these asset classes to build a resilient, cash-flowing portfolio. If you found value, subscribe and share your favorite income strategy in the comments. Thanks for watching. See you next time.